Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending March 5, 2021. Everybody, I'm Preston Brent. Thanks for tuning in. This week's theme, well, it's raining cats and dogs, or just plain old cats and dogs. We'll kind of go into this in just 1 minute. Let's kind of take a look at where we've been this past week. It was kind of a choppy week. We ended the week, believe it or not, mixed, but mostly higher. So let's go look at it and see. If we just kind of summarize the week here, we're going to see that from an index performance, you can see that the NASDAQ and the Russell, both in the red for the week, but all of them still green year to date. And the Russell's leading the way at 11.01%. The Dow and the S&P did manage to break above the zero line this week. NASDAQ had the worst week. You can see on the right-hand side of the screen, the PE ratio is at 22.15, the forward 12-month earnings projection. And we're getting a lot of varying results in where those earnings are supposed to come in for 2021, which is going to drive PE ratios, which will drive, money flow into and out of the equity markets. See, the dividend yield for the S&P came in at 1.51%. The 10-year Treasury, though, had a bump up. 10-year Treasury now yields more than the dividend yield of the S&P by about 4.4 basis points. You can see the spread there in red. So that's going to, slowly, not right now, but slowly start to divert more money from the equity market into the Treasury market. You can see the current VIX did come down from the prior Friday of 27.95. It closed this week at 24.66, so it was down a little over 11% for the week. Best performing sector this past week, energy up a whopping 10% when OPEC came out with their surprise, where they said they are not going to increase production. They're going to leave everything unchanged, so energy just rocketed higher. You can see year-to-date, energy's up 37.42% for the year, bringing up the rear for this past week. Technology, obviously those strong growth, high PE multiple tech stocks have just taken a bath recently, including the FANG stocks. Utilities also down year-to-date, leading the way down 7.1%. So we're seeing a little bit of this mix in the markets. Investors seem to be divided really whether the rise in longer term bond yields was due to an upswing in growth expectations or more of a worrisome increase in inflationary pressures. I think it's going to be a combination of both. And again, it's going to be kind of a raining cats and dogs market here near term until the markets can just get a little bit more of a firmer footing from a price pivot point perspective and a support point perspective. Also, we did see from a economic data performance this past week, we did see, as I said, tension between growth and inflation. The surprise to the upside was non-farm payrolls rising about 379,000 for the week, almost twice the consensus estimate. And a lot of the gains came in leisure and hospitality industry. That is the reopening trade for sure. Restaurants, things like that. Unemployment rate did fall just a little bit, came down to 6.2%. All right. That is a new pandemic era low since we crashed last March. Meanwhile, we got a lot of vacillation in stocks, both rising, falling, and rising sharply again to end the week, which did bring up the S&P and Dow for the week, but it kept the Russell and NASDAQ underwater. Okay, now if we look at the Treasury market, fixed income with rising inflationary pressures, it tend to resume the yield rise in Treasury. Okay, and then this past week we did hear from our illustrious Fed Chair Boom Boom Powell regarding inflation and so forth. And basically, he didn't offer any soothing words to the markets to suggest yields would be lower or they're looking at taking any kind of action on the yield curve via Operation Twist or some of the other tools that they can deploy. So the markets were looking for some kind of word and they got nothing and the market sold off. But then it ended the week this past Friday in a very strong fashion. So For now, markets seem to be in a neutral to slightly bullish mode, but I will show you the charts. We're still not out of the woods yet because we're still making lower lows and lower highs. And until we take out those key levels, then we need to assume that that trend is going to continue. Then, of course, if we go over to Europe, let's just take a look at European markets as well as others. Shares in Europe ended higher. You can see the Euro Stocks Index up 91 basis points. Those are the 50 largest companies in the index across Europe. Year to date, they're up 3.29%. You can see everybody's in the green year to date across Europe, some of the large companies, as well as the Asian markets. Same thing with the U.S. Everybody year to date's in the green, right? I mean, just really, really strong. And they're kind of buoyed across Europe that they're going to start to ease restrictions, to get more companies open. Although we did see German Chancellor Angela Hardnuts Merkel basically, and some of their regional ministers extend some of the lockdowns in some areas until the end of this month, although they're easing rules in other areas that are low infection. So we're starting to see some of the countries over in Europe start to open up, but Europe is definitely trailing the U.S. In general with what's going on there. And of course, if we come over and we take a look at China and just what's going on there, Chinese shares for the week, they were rising. You can see China was up 2.2%. Hang Seng was up about 41 basis points, but they're all year to date in the green. Overall, the Chinese tone is kind of cautious ahead of their annual Congress. Now, they call it the National People's Congress, but as I tell all of my members, any country that names something after the people is generally a socialist or a communist country. The People's Congress, the People's Bank, they do that to make the people, or what I would call the sheeple, feel better. But there's nothing about the people that drive the CCP or the Chinese Communist Party. But they started their highest profile political gathering. It kicked off this past Friday. So over the next week or so, we'll start to get pronouncements from them across where their plans for the next 5 years. Meanwhile, on the economic front in China, their PMI data, manufacturing and services for February, came in just a little bit lower than expectations. So that's a little bit about what we're seeing. I'm going to take you over and let's just take a look at some of the charts here. So I'm going to swing the screen over. It'll take a couple of seconds to paint your screen there. So while it's doing that, I'm going to go on and just move a few things around on my screen so that you can get that going here. And as it comes over, what you're going to see on the screen here is the 4-hour chart of the S&P 500 E-mini futures, right? And I like using the 4 hours, you guys know, because it kind of gives you a daily snapshot of what the daily looks like. And I'll show you both the 4-hour and the daily just to show you some of the differences. But you can see in the 4-hour chart, which is almost a trading day, you can see the dramatic bull traps that we've had, right? These bull traps trap you into believing, okay, now it's by the dip. And every one of them we've run over and we've made a lower low, right? And then we've made a lower low. And you could see these lows right like this. So by the same token, you could just put a trend line on this and just connect everything, and you can say, okay, now we're up near the upper boundary of this downsloping channel, because it's very easy when you channel it, right? You put it in a channel. So the question is going to be, are we going to break out of this and make a run up to this overhead supply up here, which is volume over price? The key level in my mind is going to be around the 3,900 level. If we can take that out, that'll be a good thing. This key level right here is also a prior pivot that we haven't been able to take out, but the key prior pivot is going to be sitting right around there, which is around 3,900. If we take that out, then the next challenge will be this, and then we'll be up over all-time highs again. Now, keep in mind, I have been bullish for the entire year, meaning we're going to get these dips in the market, but I think the market is going to end the year anywhere between 4,100 and 4,300. I have not changed my stance yet, and for those of you that look at our weekly roundup, I'll keep you posted on when that's going to change. And you guys know that follow my weekly roundup that I've been calling for anywhere from a 10 to a 15% pullback sometime in Q1. where we're going through the last month of the quarter, and this pullback from peak to trough right down in there is right at about 6%. I will tell you that we've had about 7 pullbacks since the March pandemic lows, coming off those March lows of last year. And they've been varying degrees from a little over 10%. Now I'm talking about in the S&P, not NASDAQ. NASDAQ's pulled back a little bit more. We entered official correction territory in NASDAQ the other day. But on the S&P, we've averaged about 7.2% on 7 pullbacks since the March pandemic low. Now this one right here gets us down right about 6%. Now I was calling for a little bit of a bigger than average pullback that we've had in the prior drop downs of 10 to 15%, but we may not get it. I mean, we may just have so much momentum in this market. The only spoiler in this whole thing could be inflation and rising interest rates, but we'll see. Now, this was my expectation, and I said Q1. We got a little over almost 5% the last week in January in the S&P, and now we got this 7.2% to kick off March. So this is going to be, again, longer term, I am bullish. So for our members that have a longer term portfolio, I'm suggesting selling calls out of the money or at the money, or maybe picking up some puts, especially if you own some of the technology, because some of the technology's gotten crushed. Okay. And I'll show you that in a minute. So this is a little bit about what I'm looking at on the 4-hour chart. You can see that 2020 closing price. So when you go below the blue line, you're in the red. So you can see for the year, we were in the red for about a day and a half year to date with the S&P. Okay. So just really one of those kind of crazy moves. And you can see it's a very choppy move. It's a wide channel. It is not. We have really big moves up. These counter-cyclical move or a counter move to the overall downtrend. All right. I mean, you can look at the chart and just see that it's going down, but it's a very choppy down move. And until we take out this prior pivot high over here, we got to make the assumption that we're going down, or it's going to be choppy sideways neutral market. Okay. Now I'm going to take you over and show you the exact same chart, but let's look at it on a daily basis, and you'll see what I mean. It's a little bit harder to read some of the um, uh, bull flags in this thing here. So here is the same chart on a daily. I've got it marked up the same. And you can see on this daily chart, I'll wait until it gets up on the screen for you guys, that the counter moves are a little bit difficult to see. Okay. And either way, you can see we did, again, like the 4-hour. It shows a little bit better on the 4-hour, but we moved below the opening price or the closing price for 2020. So we were in the red briefly, and now we're moving back up. So you don't see those counter moves as easily. You could see a little bit of a minor pivot there and a little bit of a minor pivot there, right? This one right here is sitting, as I said, shows up nicer on the 4-hour chart, which is what I highly recommend you guys use, because it's great for this kind of market, to just kind of, swing trade through. But you can see here this series of lower lows. Okay. And if I were to connect the lines right here, you can just see that connection right there. So that's where we're in. And this is the point I want to take out and then get up there. We'll challenge it. Now we could roll right back over again and start going back down. So that's what our check is going to be for our users and just where we're going to be. Okay. So this move here down that level right there to right here from that high, like I said, is about 6%. All right. I was calling for 10 to 15. We haven't quite hit it yet. So does that mean we got further to go? Well, no one knows the future, right? But by watching our key pivots, we can get an idea. There's very strong momentum in this chart, extremely powerful. Okay. And if I just get everything off the screen here, let me just get this off the screen, clear it up a little bit. You can see that this was almost, but not quite, a bullish engulfing pattern, because we did not make a lower low on Friday. We took out Thursday's highs, but we didn't make a lower low on Friday. I would have loved to have seen that. That would have been a little bit more of a bullish price action. but we didn't do that. Okay. Now, if we come down here and if we look at the FANG index, you can see on the FANG index, we're below. I mean, when we almost closed right at zero return year to date for the FANGs. Now, this is Microsoft, Facebook, Apple, Netflix, Google, and Amazon, right? So we closed right at that blue line. You can see right there. I mean, literally right on it, right? Just slightly below in the red for the year. Okay. So, and if I were to measure this, just the FANG index, just to show you, we'll just take it down and kind of show you where we're sitting right now. We're down a little over 6.5% now in the FANG. So it's a little bit more egregious. The larger cap is really just kind of taking it in the shorts. Okay. If we look at the Russell, well, let's go back. Let's look at one thing real quick. Let me come back to the E-mini futures here for just 1 second. Let's get it back on the screen here. One thing I wanted you to pay attention to is this red line, which is the 50 EMA. You can see we blew through it yesterday. We quickly regained it back today. So we're above the 50 EMA on the E-mini futures. If we look at the NASDAQ 100 futures, had a very strong day, but we're well below. We're in the red for the year for NASDAQ 100 futures, and we're below the 50 EMA. All right, we're sandwiched between the 50 and the 200 EMA on NASDAQ futures. So it is getting hit a lot harder. Okay. If we look at the Russell futures, and you can see with the Russell futures, we've never gone below the 50 EMA. The Russell has been, as I said, the strongest for the year. I mean, the year-to-date performance on the Russell is over 11%. It is leading almost all the world indexes higher, the major economies of the world, the Russell. So there's been a lot of money going into small cap and mid cap and banking and financials, okay? And, one way you can take a look at that is if we come down here to some ratio charts, and I'll just show you XLF to the SPYs. You can see this chart is just moving up. So when it's moving up like this is a ratio chart with the financial sector in the numerator and the SPYs in the denominator. So when it's moving up, XLF relative to the SPYs is outperforming. And this outperformance is going on for a while, but you can really say the end of January. So for the entire month of February going into March, financials have been outperforming. Okay. Now, if we look at technology, you can see here with technology, it's just the opposite. Technology has been underperforming. Now, I think this is going to offer some great buying opportunities for those of you that are willing to come in and pick some things up because they're coming down pretty good because the high valuations, the high PE ratios in some of these tech stocks, I think they got overvalued. And I think what's going to happen is you're going to see the money come back out of some of these other stocks and move back into some of these high growth tech, but not just yet. I think it's got a little bit more ways to go. Right. So these are just some of the ones that I wanted to show you. And let's take a look at, where is that other one I want to show? Let's take a look at energy. Look at energy right here. Again, just beginning of February, oil has just outpaced everything. Was the leading sector year to date as well as weekly. Just really strong, very strong performance. Of course, if we go look at volatility and see where the VIX is, as I said, it closed at 24.66. But you can see that it did spike up here on Thursday. It moved up to a high of 31.9, almost 32. And then it closed Friday, just one day later, right here at 24.66. So really almost an 8-point move lower in one day from the highs the previous day. Now, for our members, I've got a great Option Masters video on how to best trade volatility. And it goes against what some people teach. And it's an easier, higher probability trade in vol. And members, I encourage them to go in and look at it all the time. But it is a great high prob trade in vol. And it's not what you think it may be. Okay. But it's a really good trade. But that's what volatility is doing right now. And then let's look at the bond market. The bond market is just amazing. I mean, this was a trade I was calling out coming all the way back over here actually to the second week in November. I was saying you want to be selling the bond market. Back when the bond was 123 or 173 and 28 ticks, 174. It's now sitting at 156, almost 18 full handles lower. That's $18,000 per contract, guys. We've got some members that are playing it that are just knocking the ball out of the park. And now look at it since the end of January, beginning of February. It's almost like a waterfall, right? And this, of course, drives interest rates higher. TLT puts would have been a beautiful trade here. This is what I call for our members low-hanging fruit trade. It's just a trade you got to take because the probability of being wrong is a lot less. You've got the edge and the strong wind at your back. That's one you want to be playing. So that's the bond market. Interest rates, of course, they're moving higher. So if we take a look at the 10-year rates right here, I mean, it's just, look at this. It's just moving higher and higher. Okay. There's no divergences in this or the bond market for that matter. So there is no question that this is going higher. I would not suggest you chase these up here. It's going to probably run sideways, maybe even pull back a little bit, but then the longer term, they are moving higher. And there's some great ways to trade this, as I've been showing our members. The dollar. The dollar has caught some people by surprise. Look at the dollar. It's moved up higher. In fact, I've got them raise the 2021 high price on the dollar here. We broke out right here. We had another breakout right here. I think when the markets are like this, the dollar has a tendency to run up a little bit stronger than normal. But I do believe if it gets up much higher, I would be a seller of the dollar rather than a buyer. And with the euro, I would be a buyer of the euro, not a seller. Okay. I want to just see where the euro goes near term, but this was a low-hanging fruit for us over here when the euro's down here. Remember, if you guys remember, I was saying we need to go long the euro, short the dollar. It was a good low-hanging fruit trade for us. Okay. Gold markets. Well, what can you say about gold? We broke a key support level and then away we go. We're coming down to a key pivot level right down here at 1674.9. I think because it's kind of overdone a little bit, there's no divergences in here that suggests it's going to go to the moon. It could come up and test this downsloping trend line, as you can see right here. But outside of that, I don't see it going anywhere but neutral to down. Okay. Silver's the same. Silver did break out of this downsloping trend line, but it is weaker than gold. I think it's going to come down and test these lows down here near term. Okay. Energy, oil. Well, oil racked real high here. I got to move it up on Friday. This trade should be faded. I think it's going to pull back a little bit. The reason why it moved very strong was because OPEC came out and said they're not going to increase production. So the supply of oil is going to stay where it is, but the demand is continuing to grow as businesses open up, consumers get out, more people start flying. So that's going to have a tendency to push oil up, but it's had such a strong move here. I think going out of the money and selling bear call spreads in oil, or just playing a little bit of a downside action would be interesting. Now, we've been long oil, long to neutral oil going all the way back to November of last year. So our trade has worked out very nice for our members that have traded or like to trade oil. But that's kind of the trade. Now, we've also had some key energy stocks that are just knocking the ball out of the park as well. So all in all, for our members, we're doing good. We're well ahead of the S&P year to date. If you're not a member of our group, I highly encourage you to come in and join us because we do everything from equities, options on equities primarily, or in the futures market or options on futures, commodities, that kind of thing. And there's just going to be some great plays, especially as we start running higher this year. All right, everybody, that's kind of where we're sitting. Members, I will see you tomorrow evening for our weekly market watch for our weekly roundup, folks. I will see you next Sunday, or come on in and join us. I think you'll have fun. Take care, everybody. Ciao.